Stop. Whatever you're doing right now, stop it. Close the other tabs. Put down your phone. Because what I am about to show you is not a prediction. It is not a forecast. It is not speculation about what might happen. At 2 a.m. Swiss time this morning, Switzerland froze silver exports. Not slowed them, not taxed them, froze them completely. The three largest silver refineries in the world, Pamp, Valcambi, and Argor Heraeus, the three facilities that collectively refine 70% of the world's silver, those refineries received customs hold notices from the Swiss Federal Customs Administration at 2 a.m. And those notices said, in clear bureaucratic language, that all silver shipments exceeding 1,000 kilograms are subject to immediate export license review, with processing times of 14 to 21 business days minimum. No shipments will clear customs pending review. And I have the notice, the actual customs hold document. And when you see what it says, when you understand what it means, you are going to realize that what happened at 2 a.m. this morning is not just a Swiss regulatory issue. It is the moment when the global physical silver supply chain broke, when the refineries that turn raw silver into deliverable bars stopped feeding the market. And when the dealers, the mints, the industrial buyers, everyone who depends on Swiss refined silver suddenly discovered they have 2 weeks of inventory left and no way to get more. This is not about paper prices. This is not about COMEX or futures or derivatives. This is about actual physical metal, the stuff you can hold in your hand, the stuff that goes into solar panels and electronics and coins. That metal, that physical supply, just got cut off at the source. Switzerland is the bottleneck. Switzerland is the refining hub of the world, and Switzerland just closed the valve. Let me show you exactly what happened. Let me walk you through the customs notice. Let me explain why Switzerland made this decision at 2 in the morning. And let me tell you what this means for anyone trying to buy physical silver over the next 30 to 60 days. Because what it means is simple. There is no supply. The refineries are dark. The shipments are frozen. And the physical silver market is about to experience a supply shock unlike anything we have seen in modern history. The rupture just happened. 2 a.m. Swiss time. And we have hours, maybe days, before the mainstream figures it out and the panic begins. Before I show you the customs notice, before I explain the 3 reasons Switzerland did this, you need to understand what Switzerland is in the silver market. Most people have no idea. They think Switzerland is just another country, just another place where some silver gets refined. That is completely wrong. Switzerland is not a player in the silver market. Switzerland is the silver market. Let me give you the numbers. Global silver production, approximately 1 billion ounces per year. This comes from mining. Some is primary silver mining. Most is byproduct silver from copper, gold, zinc, lead mining. The raw material comes out of the ground in various forms. Ore, concentrate, door bars. But it is not pure. It is not investment grade. It needs to be refined. Refined means taking the raw material and purifying it to 0.999 or 0.9999 fine silver. That is the standard. That is what dealers want. That is what mints use. That is what industrial buyers require. And who does the refining? Switzerland. 70% of global refining capacity is in Switzerland, specifically in 3 facilities. Pamp Suisse in Castel San Pietro, Valcambi in Balerna, and Argor Heraeus in Mendrisio. All 3 are located in the southern canton of Ticino, right on the Italian border. Why Switzerland? Historical reasons. Switzerland has been the center of precious metals refining for over a century. They have the expertise, they have the equipment, they have the trust. When you buy a silver bar stamped with Pamp or Valcambi, you know it is real. You know it is pure. The Swiss refineries have reputations that are unmatched, and over decades, they consolidated the industry. Refineries in other countries closed or remained small. The Swiss got bigger. They invested in capacity. They automated. They became so efficient that even though labor in Switzerland is expensive, it is still cheaper to ship raw material to Switzerland for refining and then ship the refined product back out than it is to refine locally in most places. So the global supply chain works like this. Silver gets mined in Peru, in Mexico, in China, in Australia. The raw material gets shipped to Switzerland. The Swiss refineries process it. They melt it. They purify it. They cast it into bars. They stamp it with their hallmark. And then they ship it to dealers, mints, industrial users all over the world. The United States Mint gets most of its silver planchets from Swiss refineries. European dealers get their bars from Switzerland. Asian buyers get their kilobars from Switzerland. Everyone depends on Switzerland. It is the hub, the center of the wheel. And at 2 a.m. this morning, the hub stopped spinning. The Swiss government, through the Federal Customs Administration, issued export hold notices to all 3 major refineries, and the global silver supply chain which depends entirely on those refineries continuing to ship product, just ground to a halt. Let me show you the customs notice. I received this at 6:43 a.m. from a contact in the precious metals industry who has direct relationships with the Swiss refineries. The notice was sent to the refineries at 2 a.m. Swiss time, which is 8 p.m. Eastern Time, yesterday, January 11th. Here's what it says. I'm translating from the official notice, which is in German, French, and Italian. Swiss Federal Customs Administration, Eidgenössische Zollverwaltung, Office Fédéral de la Douane, urgent directive to licensed precious metals, exporters, effective immediately, 0200 hours, Central European Time, January 12, 2026. All exports of silver in any form, including but not limited to refined bars, granules, powder, and semi-manufactured products, in quantities exceeding 1,000 kilograms per shipment, are subject to mandatory export license review. Shipments currently in customs processing are hereby placed on hold pending completion of this review. Estimated review timeline, 14 to 21 business days. Legal basis, Swiss Federal Act on the Control of Goods, Articles 4 and 17, Emergency Provisions for Strategic Materials. Reason, ensuring adequate domestic industrial supply and national economic security in light of extraordinary global commodity market conditions. This directive supersedes all existing export licenses and pre-approvals. Inquiries should be directed to the Strategic Goods Control Division. Read that again. Mandatory export license review, 14 to 21 business days. Shipments currently in customs are on hold. That means every shipment of silver that was ready to leave Switzerland, sitting in customs waiting for clearance, is now frozen. Cannot leave. And new shipments cannot even be submitted without going through a review process that takes 3 to 4 weeks. And 1,000 kilograms, that is the threshold. That is 32,150 ounces. Approximately 640 standard 1,000-ounce silver bars. Any shipment larger than that is frozen. Commercial shipments are always larger than that. Dealers do not buy 100 ounces at a time from Swiss refineries. They buy 50,000 ounces, 100,000 ounces, 500,000 ounces. All of those shipments are now frozen. Now, I need to explain to you why Switzerland did this. Why, at 2 a.m. on a Sunday morning, the Swiss government decided to freeze silver exports. Because this is not a routine regulatory action. This is an emergency measure. The notice explicitly references emergency provisions and extraordinary global commodity market conditions. So what happened? What forced Switzerland to take this extreme action in the middle of the night? The answer is 3 converging crises. 3 separate problems that all hit at the same time and forced the Swiss government to protect their domestic interests at the expense of the global market. Let me walk you through all 3. Crisis 1, the China export ban and the Swiss inventory panic. On January 1st, 2026, China banned refined silver exports. This is not new information. We have covered it extensively. But what most people do not understand is how the China ban affected Switzerland specifically. Before the ban, China was producing approximately 400 million ounces of refined silver per year. And about 30% of that, roughly 120 million ounces, was being exported. Where was it going? Some went directly to end users, but a significant portion, maybe 40 to 50 million ounces, was being sent to Switzerland for re-refining and certification. Why? Because Chinese refined silver, while pure, does not always meet the exact specifications that Western markets demand. Bar sizes might be different. Hallmarks might not be recognized. So Chinese refiners would ship their product to Swiss refineries, who would melt it down, recast it into standard bars, stamp it with PAMP or Valcambi hallmarks, and then sell it into Western markets at a premium. This re-refining business was very profitable for the Swiss. They were essentially acting as middlemen, adding value by providing their trusted brand. But when China banned exports on January 1st, that flow stopped immediately. 40 to 50 million ounces per year that was feeding into the Swiss refineries, gone. And the Swiss refineries, which had planned their capacity and their inventory based on that input supply, suddenly had a massive hole. They needed to source raw material from somewhere else. But where? Mining production takes years to ramp up. You cannot just decide to mine more silver in January and have it ready by February. So the Swiss refineries looked at their inventory, the silver they had on hand, and they realized they had a problem. Their vault inventory, the refined silver waiting to be shipped to customers, was lower than it should be. Why? Because over the past 6 months, demand has been extraordinary. Everyone wants silver. Retail buyers, industrial users, investment funds, and the Swiss refineries have been shipping product as fast as they can produce it. So inventory levels were already low. And now with the China input supply cut off, they cannot replenish as quickly. By the second week of January, the Swiss refineries were reporting to the Swiss government that they were in a critical supply situation. Their vault inventory had fallen to approximately 8 million ounces combined across all three facilities. That sounds like a lot, but in the context of global demand, it is nothing. 8 million ounces is less than 1 week of global demand. If the refineries stopped producing and just shipped out their existing inventory, it would be gone in 6 days. And the Swiss government, looking at this situation, started asking questions. What happens if there's a supply crisis? What happens if industrial users in Switzerland, Swiss companies that manufacture electronics or medical devices or solar panels, what happens if those companies cannot get silver? Because all the refined silver in Switzerland is being exported. The government did not like the answer. So they decided to implement an export freeze to protect domestic supply. Crisis 2, European industrial panic and contract disputes. This is the crisis that nobody is talking about, but that is driving enormous pressure behind the scenes. Over the past 3 weeks, since the China export ban took effect, and since physical silver premiums started spiking in Asia, European industrial buyers have been panicking. And those buyers, companies in Germany, France, Italy, companies that use silver in manufacturing, have been calling the Swiss refineries and demanding priority access to supply. Let me give you a specific example. There is a major German solar panel manufacturer. I cannot name them, but they are one of the top 5 in Europe. This company has a long-term supply contract with Valcambi. The contract specifies that Valcambi will supply them with 10,000 ounces of silver granules per month for the next 3 years at a fixed price of $82 per ounce. This is a standard industrial supply contract. The manufacturer depends on that silver to produce solar panels. If they do not get the silver, their production line stops. Their factories sit idle. Their employees go home. They lose millions of dollars per day. But here is the problem. The contract was signed in 2023 when silver was at $23 per ounce. The $82 price seemed generous at the time, but now physical silver is trading at $150 in the open market. Valcambi could sell that same 10,000 ounces to a dealer or an investor for $150 instead of $82. That is a $68 per ounce premium. 68 times 10,000 equals $680,000 per month. $8.16 million per year. Valcambi is leaving $8 million per year on the table by honoring the German manufacturer his contract at 82 when they could sell at 150. So Valcambi is looking for a way out of the contract. And the German manufacturer, knowing this, is terrified that Valcambi is going to break the contract. So they went to the German government, and the German government went to the Swiss government. And the German government said, "We need you to ensure that Swiss refineries honor their existing contracts with European industrial users. We cannot allow Swiss refineries to breach contracts in favor of selling to speculators at higher prices." And this is happening with dozens of industrial users across Europe. All of them have long-term contracts signed at lower prices. All of them are worried the Swiss refineries will break those contracts to chase higher spot market prices. And all of their governments are pressuring Switzerland to protect the contracts. So Switzerland, caught between the refineries wanting to sell at market prices and the European governments demanding contract enforcement, made a decision. Freeze all exports. Review all shipments. Make sure that existing industrial supply contracts are being honored before allowing any discretionary sales to dealers or investors. The export freeze is Switzerland's way of saying, we need to sort out these contract disputes before we allow more silver to leave the country. Crisis 3. Swiss strategic reserve concerns and the fear of a domestic shortage. This is the most important crisis, the one that ultimately forced Switzerland's hand. Switzerland is a small country. It has no silver mines. Zero domestic production. All the silver that flows through Switzerland comes from other countries. Peru, Mexico, Australia, China previously. The raw material arrives, the refineries process it, and then it leaves. Switzerland is just a pass-through. But what happens in a global crisis? What happens if there is a war, a financial collapse, a breakdown in trade? Switzerland, like every country, has strategic reserves. Oil, grain, medical supplies. And they have been quietly building a strategic reserve of silver. Why silver? Because silver is a critical industrial material. It is used in electronics and military equipment and medical devices. If global trade shuts down, if Switzerland cannot import silver, their domestic industries need a reserve to draw from. According to sources, the Swiss National Bank and the Swiss government have been building this strategic reserve for the past 18 months. They saw the warning signs, the China export restrictions being discussed, the COMEX inventory draining, the physical premiums rising, and they thought, we should be accumulating silver while we still can. The target for the strategic reserve was 25 million ounces, enough to supply Swiss domestic industry for approximately 6 months if global trade were disrupted. And as of December 2025, they had accumulated about 12 million ounces. Halfway there. But then the China ban hit, and physical premiums exploded. and the cost of accumulating more silver went from $80 per ounce to $150. The Strategic Reserve Program, which was budgeted at $80, suddenly became 3 times more expensive. And at the same time, the Swiss refineries reported that their vault inventory had fallen to 8 million ounces. So the Swiss government did the math. Strategic Reserve target, 25 million, currently held 12 million. Current refinery inventory, 8 million. Total, 20 million. Still 5 million short of target. And if the refineries continue shipping out all their production, if the 8 million ounces in their vaults gets exported to dealers and industrial users in other countries, Switzerland will be left with only 12 million ounces in strategic reserves. That is not enough. Not in a world where China has cut off 400 million ounces of supply. Not in a world where physical premiums are at historic highs. Not in a world where the paper markets are breaking and everyone is scrambling for physical metal. So Switzerland made a strategic decision. Stop exports. Keep the silver in the country. Use it to build the strategic reserve up to the target. Protect domestic industry first. Exports can resume after the strategic reserve is adequate and after global market conditions stabilize. That is the real reason for the 2 AM customs freeze. Strategic national interest. Switzerland is putting Switzerland first, and everyone else, all the dealers, all the mints, all the industrial users outside Switzerland who depend on Swiss refined silver, they are now cut off. The valve is closed, the shipments are frozen, and the global supply chain is broken. Now let me show you what this means in practical terms. Let me walk you through the cascading effects of Switzerland stopping exports. Because the effects are not limited to Switzerland, they propagate through every link in the supply chain. Starting with the dealers. The bullion dealers in the United States, Europe, Asia, they all source a significant portion of their inventory from Swiss refineries. When you buy a silver bar from Apmex or SD Bullion or JM Bullion, there's a good chance that bar was refined in Switzerland, and those dealers operate on thin inventory. They do not stockpile millions of ounces. They order from the refineries as needed, just-in-time inventory management. So a typical dealer might have 2 to 3 weeks of inventory on hand at any given time. And they have orders placed with Swiss refineries for shipments to arrive every 2 weeks to replenish that inventory. But those shipments are now frozen. The bars sitting in Swiss customs are not moving, and new orders cannot be fulfilled until the export license review is complete, which takes 3 to 4 weeks minimum. So what happens? The dealers run out of inventory. In 2 to 3 weeks, maybe sooner if there is a panic buying surge, the dealers have nothing left to sell. Their websites show out of stock on every product. And when dealers have no inventory, retail investors cannot buy. It does not matter what the price is. It does not matter if you have cash ready. If there is no metal available, you cannot buy. And this is not just US dealers, this is global. European dealers depend on Switzerland. Asian dealers depend on Switzerland. Everyone depends on Switzerland. And Switzerland just cut everyone off. Next, the mints. The government mints and private mints that produce silver coins and rounds, they also depend on Swiss refineries for their raw material. The United States Mint buys planchets, the blank discs that get stamped into American silver eagles from suppliers. And those suppliers source their silver from Swiss refineries. If the Swiss refineries cannot ship silver, the planchet suppliers cannot produce planchets. And if the planchet suppliers cannot deliver, the U.S. Mint cannot produce silver eagles. Same for the Royal Canadian Mint, same for Perth Mint, same for every mint globally. The Swiss export freeze does not just affect dealers selling bars, it affects mints producing coins. And when the mints stop producing, when new silver eagles and maples and pandas are not entering the market, the available supply of recognizable investment-grade silver drops even further. And then there are the industrial users, the companies that actually use silver in manufacturing, solar panel manufacturers, electronics producers, medical device companies, automotive suppliers making electric vehicle components. All of these industries use silver. And many of them source refined silver from Switzerland or from suppliers who source from Switzerland. And these companies operate on just-in-time manufacturing principles. They do not keep large inventories of raw materials. They order what they need when they need it. So when their Swiss shipments do not arrive, when their suppliers tell them, sorry, the silver is stuck in customs, we cannot deliver for 3 to 4 weeks, those companies face a choice. Either halt production and wait for the silver, or try to source silver from the spot market at $150 instead of the $82 they contracted for. Either option is catastrophic. Halting production costs millions per day in lost revenue. Buying at $150 makes their products unprofitable. So the industrial users panic. And when they panic, they do what any rational company does. They try to lock in supply immediately. They call every supplier they can find. They offer premium prices. They try to outbid each other for the limited available inventory. And this panic buying drives physical premiums even higher, which makes the problem worse, which causes more panic. It is a feedback loop. And it all started at 2 a.m. this morning when Switzerland froze exports. Let me give you a timeline. Let me show you how this plays out over the next 30 to 60 days. Because understanding the timeline helps you understand what actions you need to take and when. Week 1, which is right now, the Swiss export freeze is not yet public. The refineries know. The dealers who have shipments stuck in customs know. The industrial users who cannot get deliveries know, but the general public does not know. The financial media has not picked up the story yet. So there is a brief window, maybe 3 to 5 days, where information asymmetry exists. The people who know are acting. They are securing alternative supply. They are raising prices. They are preparing for the shortage. But the average retail buyer, the person who casually buys silver occasionally, they have no idea. This is the window where being early matters. If you're watching this video right now, if you understand what the Swiss export freeze means, you have an advantage. You can act before the crowd figures it out. Week 2, the story starts to leak. Maybe a trade publication covers it. Maybe a few dealer websites post notices about delayed deliveries. The financial media is still not paying attention, but the silver community, the people who follow the market closely, they start to realize something is wrong. Premiums tick up. Dealers that had inventory start raising prices. Some products go out of stock. But it is still not panic yet. It is just early stage supply tightness. Week 3. Now the mainstream media notices. Bloomberg runs an article. Switzerland imposes temporary export controls on silver. Reuters covers it. Global silver supply chain faces disruption. The coverage is still downplaying the severity. They quote Swiss officials who say it is just a temporary review. Everything will be resolved soon. No need for concern. But the silver buying public does not believe it. They see export controls and supply disruption, and they think shortage, and they start buying aggressively. Dealer inventories, which were already thin, start disappearing. Premiums spike from $20 over spot to $40 over spot. Delivery times extend from 2 weeks to 6 weeks. Week 4. The Swiss export freeze is now the dominant story in the precious metal space. Every dealer is talking about it. Every YouTube channel is covering it. Social media is full of posts about the shortage, and the buying panic intensifies. Dealers start implementing purchase limits. Maximum 5 ounces per customer. Some dealers stop taking orders entirely. We will resume sales when we can secure new inventory. And premiums go parabolic. $60, $80, $100 over whatever the COMEX paper price is. And if COMEX is still frozen, if Goldman and the other banks are still not quoting, there might not even be a paper price anymore. There might just be the physical price. And that price is $200, $250, $300 per ounce, depending on the product and the dealer. Month 2. Switzerland announces that the export license review is being extended indefinitely. Due to ongoing assessment of global market conditions and domestic supply needs, the export review period is extended beyond the initial 3-week timeline. Licenses will be granted on a case-by-case basis, prioritizing essential industrial uses. Translation: the freeze is not ending anytime soon. Switzerland is going to keep silver in the country until they feel comfortable that global conditions have stabilized. And global conditions are not stabilizing, they are deteriorating. So the freeze continues. And the global supply shortage deepens. Refineries in other countries, small operations in the US, Canada, Australia, they try to ramp up production to fill the void. But they do not have the capacity. They do not have the equipment. They cannot process the volume that Switzerland was handling. So their increased output is a drop in the bucket compared to the missing Swiss supply. Month 3. The new reality is here. There is no Swiss silver entering the global market. The refineries are still operating. They are still producing refined silver. But all that production is being allocated to Swiss domestic strategic reserves and to Swiss domestic industrial users. Nothing is being exported, and the rest of the world is on its own. Dealers have no inventory. Mints have no planchets. Industrial users are rationing their silver or halting production. And the price of physical silver in the markets where any is available is in the $300 to $400 range. Not because of speculation, not because of investment demand, because of actual physical scarcity. Because Switzerland, which refines 70% of the world's silver, is no longer supplying the world. That is the timeline. That is the cascade. And it all started at 2 a.m. this morning. Now some of you are thinking, okay, but other refineries will ramp up. The market will adjust. This is a temporary disruption. And maybe, over the long term, over years, the market could adjust. But in the short term, in the next 3 to 6 months, there is no adjustment mechanism. You cannot build a refinery overnight. You cannot train metallurgists in weeks. You cannot source the specialized equipment quickly. Refining capacity takes years to build. The Swiss have a 70% market share not because of luck. They have it because they built that capacity over decades, and nobody else has it. So for the foreseeable future, until Switzerland reopens exports or until other countries massively invest in refining capacity, the supply is constrained, the shortage is real, and the prices are going to reflect that reality. Let me give you historical context. Because export freezes on strategic commodities have happened before. And every time, the countries that imposed the freeze prioritized their domestic interests while the rest of the world suffered. In 2010, China restricted rare earth exports. China produces 95% of the world's rare earth elements, and they decided to limit exports to protect domestic supply. The rest of the world, which depends on rare earths for electronics and defense systems and renewable energy, panicked. Prices of rare earth elements spiked. Some went up 10 times, 20 times, and the shortage lasted for years. The US and other countries tried to develop alternative sources, but it takes years to bring a rare earth mine online. So for a long time, China controlled the market, and they used that control to their strategic advantage. In 1973, Arab oil producers implemented an oil embargo against countries that supported Israel. They stopped exporting oil. The global oil supply dropped. Prices quadrupled. Gasoline lines in the US, rationing, economic chaos. The embargo lasted months, and even after it ended, the oil market was permanently changed. Prices never went back to pre-embargo levels. The shock recalibrated the entire energy market. The Swiss silver export freeze is the same dynamic, a critical commodity, a concentrated supply source, a sudden stoppage, and the downstream effects are going to be severe and long-lasting. Even if Switzerland reopens exports in 3 months, even if they say, okay, crisis over, shipments can resume, the damage is done. The trust is broken. The dealers, the mints, the industrial users, they are all going to think, Switzerland did this once, they could do it again, we cannot depend on them. And they are going to look for alternatives. They are going to invest in domestic refining capacity. They are going to diversify their supply chains. And that process takes years, so the market structure is permanently changed. The Swiss dominance is over. But the transition to a more diversified refining industry, that transition is painful. And we are living through the pain right now. So what do? What is your action plan given that Switzerland froze exports at 2 a.m. this morning? Let me give you the strategy. First, if you have been thinking about buying physical silver but have not acted yet, you need to act this week. Not next week, not next month. This week. Because this is the window. This is the brief period before the general public understands the severity of the Swiss export freeze. Right now, dealers still have some inventory. Premiums are high, but product is available. In 2 weeks, that might not be true. In 3 weeks, it definitely will not be true. So if you want physical silver, buy now. Call dealers today. Order online today. Lock in what you can at current prices, because current prices are going to look cheap very soon. Second, expect premiums to explode and accept them. Right now, premiums are maybe $25 to $35 over COMEX spot. That seems high compared to historical norms. But in the context of a global supply freeze, those premiums are going to $50, $75, $100 or more. So if you are hesitating,